Right, good morning, everybody. It's 10:30 and welcome to JM Finn's Spring Seminar. Our next speaker this morning is Michael Bray. Michael is a member of our research team. And as I mentioned earlier, our research team work tirelessly on keeping relationships with the companies in which we invest our clients' assets, but also to provide research on individual companies to help our investment managers put together client portfolios. Michael is also chairman of our stock selection committee. So, Michael, thanks for joining us today. I'm just going to try and share our presentation. So, if you just bear with me, fingers
Sure.
crossed.
Can you hear me all well and good?
We can indeed. Thank you.
Great. Brilliant. So, firstly, good morning, everyone. So, these are some of the headlines you may have seen over the last few months. UK household savings rise sharply. Britain's prepared to spend their savings as lockdowns ease. UK labour market rebounds strongly. Well, what I will say is, for once, the headlines are correct. We will run through the data behind them shortly and what the overall state of play is for the UK economy. But before we do, let's look at where we were. The pandemic has hit the UK harder than most other major countries. On the y-axis, we have the latest release, should I say, of GDP data from the fourth quarter of 2020. And on the x-axis, we have COVID deaths per million of the population. The UK's position can be seen towards the bottom right of the graph. It's seen one of the worst year-over-year GDP performances, declining by 7.3%, and one of the worst in terms of COVID deaths per million of the population, behind Italy and Spain. It must, however, be added that the decline in UK's GDP has been accentuated by the more onerous way in which the Office for National Statistics estimates output. Nonetheless, the UK's large service sector and relatively more severe lockdown is the primary cause of the large decline. The flip side of this is that given the relatively strong vaccine rollout of the UK, represented by the red line, versus international peers, it should follow that its economic recovery will be stronger as well. Early reads of economic activity show this is the case. So GDP data is lagged, but high frequency data shows a more up-to-date picture. Here we have four of the latest high frequency metrics: London traffic congestion, public transport usage, high street footfall, and restaurant bookings. As you can see, all are recovering well as lockdown restrictions ease, with London traffic congestion figures now actually higher than they were pre-pandemic in 2019. Looking beyond the immediate short term, we expect GDP's recovery to gather pace as restrictions ease, and this is represented by the orange part of this graph line. The UK economy began the year 7% below its pre-pandemic peak. But assuming the government sticks to its plan for reopening the economy, with all legal limits on social contact lifted by the 21st of June, we expect GDP to recover to pre-pandemic levels by the end of the year. Although GDP is set to recover to pre-pandemic levels this year, employment will not. The unemployment data here stretches all the way back to 1971. Historical data is shaded blue and forecasted data is shaded orange. The shock delivered to the economy by the pandemic last year has left it operating with a significant spare margin of capacity. To date, this slack has shown up as lower capacity utilization and hours worked. The furlough scheme has prevented a large increase in unemployment, but with jobless rates ticking up from 5% to 4% at the start of the pandemic. The extension of the furlough program to September should protect the jobs market while the recovery gathers momentum. But as the program ends, unemployment is likely to rise, with the expectations that it reaches 6% by the end of the year. One of the offsets to the expected rise in unemployment is the substantial increase in savings which have occurred during the pandemic period by UK households, like Giles mentioned, and this is represented by household excess deposits. You can see that since the beginning of the pandemic, there's been a huge uptick in savings, with the Bank of England estimating that by the end of the first quarter of 2021, UK households would have saved in excess of £150 billion. Around 60% of UK expenditure is consumer-based, so the willingness of households to spend as restrictions ease will be the primary driver of the recovery. A number of market commentators believe that increasing consumer confidence and in turn consumer spending could drive upside to GDP projections. The obvious downside being a worsening turn in the pandemic. Since the Brexit referendum in June 2016, UK business investment, represented by the orange line, has generally lagged that of the medium of G7 businesses when excluding the UK, represented by the grey line. The pandemic has understandably led to a decline in UK business investment, and as of the fourth quarter of 2020, it was 7% below its level at the end of 2019. We can see towards the end of last year, business investment did begin to recover. The outlook for business investment is more balanced, however, when compared with consumer consumption, where the risk is more likely to be tilted to the upside. But business investment is likely to benefit from reduced Brexit uncertainty and a recovery in global demand, along with the government's temporary super deduction capital allowance, which will allow companies for 2 years to be able to offset 130% of investment spending on eligible plant and machinery against profits, providing a big incentive to bring investment spending forward. In regards to the government's fiscal expenditure, the decision in March to extend its support programme means borrowing in 2021 to 2022 is likely to exceed £200 billion. That's down from about £345 billion in 2020 to 2021 period, and will continue to provide support as the UK exits the pandemic. Further ahead, Chancellor of the Exchequer, Rishi Sunak, has taken measures to narrow the deficit, but importantly, these will not begin to kick in until 2022. A rise in corporation tax to 25% from 19% will not occur until 2023, and the freezing of income tax allowances will not occur until 2022, both of which are expected to raise almost £25 billion. Those decisions are likely to be enough to balance revenue against day-to-day spending in the medium term and leave the headline deficit at 3% of GDP. And yes, as I said, it will leave the medium headline deficit at 3% of GDP. So whether Sunak chooses to tighten policy will partly depend on the scale of the long-term damage from the pandemic. It's possible the Office for Budget Responsibility lowers its estimate of scarring in its next forecast if the recovery exceeds expectations, which would reduce the need to tighten further. In regards to Brexit, the volume of goods traded between the UK and EU plunged by 36% in January. Exports to the EU are represented by the light blue line, and imports are represented by the orange line. The scale of the decline is unsurprising given the abrupt shift to a very different trading relationship at the start of the year. It's also likely that the fall was magnified by the impact of COVID lockdowns and stockpiling ahead of the Brexit deadline. Volumes recovered some ground in February, although volumes ran some 8% below the third quarter 2020 level. The rebound is likely to continue this year, with stronger external demand in the form of exports and domestic spending in the form of imports, benefiting both sides of the trade ledger. Longer term, higher trade barriers that would have resulted from Brexit are likely to reduce cross-border flows with EU countries. The question therefore becomes whether imports and exports with non-EU countries, represented by the dark blue and purple lines, will make up for this shortfall. During the pandemic period, the Bank of England has provided a substantial amount of support to the economy in terms of bank rate cuts and quantitative easing, or QE. The magnitude of this support can be seen by the fact that some £450 billion of QE was provided, and that's over double the amount that was provided during the 2008-2009 financial crisis. Monetary policy is likely to continue to be accommodative, with recent comments from the Bank of England suggesting that it is no hurry to tighten policy. Although short-term prospects have improved, the Bank of England say it's not clear that the outlook has changed over the medium term. If the recovery does disappoint, we see the Bank of England as more likely to use negative rates than QE, but it may initially opt for a use of policies given the uncertainty about the impact of going below a 0% bank rate. So what about inflation? Well, the improving outlook for consumer and business expenditure, along with continued near-term fiscal and monetary support from the government and Bank of England, mean we are likely to see a period of rising inflation. This should, however, not be feared, and is a sign of a recovering economy. Based upon current projections, represented by the orange part of the graph line, inflation is expected to rise towards the Bank of England's 2% target rate by the end of the year. The various COVID-19 restrictions imposed on day-to-day life over the past year have nonetheless injected volatility into inflation figures. Supply chains have been disrupted and are taking time to recover, and year-over-year inflation figures are now being compared against the low prices at the beginning of the pandemic period. We may therefore see some upside to inflation expectations, but as things stand, the factors that underlie this look transitory in nature. My discussions so far on the UK's macroeconomic outlook have centred on the short to medium term. But what about the trajectory of the UK's long-term success? Some of you may have seen the editorial I wrote for JM Finn's Autumn Prospect magazine last year, where I talked in detail about how the UK can improve its productivity. That being the economic output our labour force is capable of producing. As you can see from the graph, which stretches all the way back to 1760, improving productivity, the blue line, is the surest way to raise real wages, the red line, and GDP per head, the green line. The UK's productivity has stagnated since the 2008 global financial crisis, and improving it is not something that can be done overnight or even within a few years. If this current government is committed to its levelling up agenda, it will need to invest a substantial amount of time and resources into ensuring the UK's labour force is correctly skilled, and that technological and business know-how is more effectively disseminated to businesses of all sizes, not just amongst the largest. The degree to which the UK can improve its productivity will be the ultimate driver of its long-term success. On the investment implications of what I've discussed, it's important to state that the UK is just a small part of the global financial system. It represents around 3% of global GDP and accounts for 4% of the global equity market. So it follows that what's happening from a monetary and fiscal perspective globally is likely to have a bigger bearing on our financial markets, particularly for more internationally focused companies. Having said that, fiscal and monetary trends globally are, to different extents, mirroring what's happening in the UK. We would therefore expect a continuation of what we've discussed previously with you, which is for equities to continue to outperform fixed income, given that interest rates are much more likely to rise than fall. The consideration of inflation protection. Although we expect inflation to remain within target range, risks to inflation look to be towards the upside. So inflation protection in the form of inflation-linked gilts, for example, would be wise to consider. In regards to the high-level debate of investment styles of growth versus value, we would expect an outperformance from growth. Although the outlook for unloved value stocks, such as retailers, has improved recently, we currently still expect the interest rate environment over the medium to long term to remain benign, favouring growth companies who generate more of their profits in future years. We do, however, continue to have a strong preference for cash generative growth companies with established competitive advantages and exposure to structural growth. And lastly, in regards to income from growth portfolios, we believe a total return approach should be considered and have a preference for income to take the form of capital drawdowns rather than trying to find income from high dividend yielding stocks, which in my experience are more often than not low growth companies. So thank you all for listening. Hopefully you found that presentation useful. If you have any questions regarding the UK macroeconomic outlook, then please feel free to speak to your investment manager. And with that, Ollie, I'll hand back to you.
Thanks very much, Michael. We've had a number of questions in, and if you don't mind, I'll just ask this one. You briefly touched on improving the UK's productivity, and you referenced an article you wrote. Could you just quickly run through a couple of examples about what you think the government should do to boost productivity?
Yeah, sure. Good question, and it's quite a complex one, but I'll try to give it a short answer. I think the good thing is that the UK's productivity problem isn't due to a lack of innovation. We consistently rank within the top 5 countries globally for innovation. We score highly in terms of our R&D spend, citable scientific research. We have some of the best universities in the world. Rather, the issue is that we have a small set of world-leading businesses, but a long tail of low productivity companies which are acting as a drag. So, for example, 3/4 of the UK's R&D spend is accounted for just 0.01% of its companies, and that really shows that dispersion. So, onto the question of how we counteract that. I think firstly, the way of really looking at it is through the prism of knowledge diffusion structure. So that's technological, and this is how technological and business know-how are disseminated, more easily throughout the entire economy. So the UK has catapult centres which do provide this infrastructure, and they're actually modelled on the German Fraunhofer system, which has been in existence since 1948 and led the post-war efforts there. But they do pale in significance in terms of their size and the resources that they receive. So more funding needs to be given to that, towards the catapult centres. And there's no reason, in my opinion, that we couldn't leverage our extensive university networks to scale that up more quickly. And equally, in regards to disseminating skills, the most proven way of enhancing technical and managerial practices tends to involve relatively intense on-the-job support, classroom-based instructions, and experimental learning. So the same is true for increasing work capacity in terms of knowing how to use technologies. So there does suggest that a more formal network of knowledge exchange at a national level is required. And the Germans do actually have quite a good system of that as well, and that's called their Stein-Best system. So those are just a few examples, Ollie, there. But I would say if anyone's interested, I would recommend reading my article, which goes into a lot more detail about that. And I believe that's also available online for everyone if that's of interest.
It is indeed. Michael, thank you very much. I think we're bang on 12 o'clock, so we're just going to wrap it up there. Michael, thanks again for your time this